And
No, 10 is wrong.
I don't know what I did, but it was like.
Yeah. No, 10 was the cost of equity, cost of capital, with all equity financing. So that was RU. That's what you're not supposed to do. So if you put 11 in, I think you're right. I was going to say, if you got that one wrong, then the chances are quite good that you got the next bunch wrong, because you have to have it.
The one you had to it was when I rebalanced.
Oh, when the rebalancing. Got you. Yes. Yeah, you could. Yeah. Okay, I see what you mean. All right. So let's see what we're doing here. Conversation is looking good. Okay. Now let's see if we can share a file. I don't need this thing for anything. Okay. Let's get rid of this. And let's go to Word. Let's go back to Teams and let's share a file.
That made me mad, but at least I knew what I was. I knew
Yeah,
how to do
well, of course you did. That's good to hear. A lot of people did, by the way. There's something like 1,100. Quite a few. All right. Let's begin. We'll be doing financial forecasting. Let me check my status here. Okay, so I have my mic on, camera's on, and I am sharing a file. Okay, I think we're good. Okay, the purpose of financial forecasting is to estimate a company's external funding requirement for the upcoming period. So companies have two sources of funding, internal and external. Internal funds. In general, an increase on the left side of the balance sheet is a use of funding, while an increase on the right side is a source of funding. So basically, the capital which funds the company is on the right side. The assets which the capital is funding are on the left side, right? So internally generated funds come from two sources. A company's earnings, and what are those two places where earnings go again? Retained earnings or what? A dividend, right? You know that, of course you do. And increases to current liabilities that change with revenues. And those are sometimes called spontaneous current liabilities. And for our purposes, we will include only accounts payable and accruals. And that's not not an over-the-top simplification, because the only difference is if you download a 10K, you'll find more than one payable account, you'll find more than one accrual account, and that's fine. But so I just lump them everything together as just accounts payable and accruals, right? So by the way, if you would have downloaded this file before yesterday, please do it again, because the original version I had these financial statements as a picture, and obviously you can't play with them much if they're going to be a picture. So I converted them to just a table, and so this we can use. So let's drop this into Excel. Okay, let's just watch Excel for a little while. There we go. All right, I'll drop it into Excel. All right, we'll blow this up so you can see it. All right, and then we'll download the balance sheets. Right here. So let's get the balance sheet. And we'll drop that into Excel. And for now, let's just drop it in right here. Yeah, that's good. Okay. Now what I'd like you to do is, instead of using a left-right orientation, let's use a top-bottom orientation. So let's take the right side and move it such that it is just below the left side. All right, like one down below here would be good. And then let's eliminate all these blank rows we don't need. Okay, and let's see how these look. Oh, these are good. All right. A little more room here, maybe. There you go. Okay. So let's make a forecast. And our assumption, in fact, let's, if we could, I guess I should have, let's show the years here. So this is 2019, and this is, we're making the forecast for the following year. Okay, so the increase in revenues and sales is 20%. If we wanted to make this a very spiffy sheet, we would put that over here somewhere, you know, as we'd have a input box where we input all of our parameters. Well, we're just going to do one. We're not going to flex this in any way. We're just going to do one analysis. So we don't need to do that. So let's just say it equals this one times 1.2. Okay. All right, and then the variable costs, we will be assuming that stays the same as a percent of sales. So we'll just increase this by 1.2 and multiply it by 1.2. And then we have this notion of fixed costs that they're, quote, fixed. Well, they're actually fixed within a certain range. And once you reach full capacity in your operations, then they basically become another variable cost. So what we're going to do, we're going to increase these also by 20%. So you basically just have to pull this down. And then we'll do an EBIT very quickly. All right. Interest. Well, at this point, since we don't know how much additional borrowing we will be doing, we'll keep this exactly as it is. Now, if you want to have a very detailed analysis, what you would do would be to go through this, find your financing alternative that you would go with, and then recast the income statements to reflect the new interest. We're not going to go into that kind of detail. Okay, so we'll just keep going here. So 120 subtracting 10, and then our taxes. Okay, now taxes. Sometimes your 10Ks will have a marginal tax rate that's specifically indicated. Otherwise, you have to use your best information or find an imputed rate. So let's just see what we did last year. This company paid 18.9 in taxes on 90 of taxable income. So they pay 21%. So what we'll do, we will take that same 21% times the current year's taxable income, and we get 23.1. So our after-tax income would be 86.9, and then now what part of this do we pay as a dividend? One more time, we will use an imputed percentage. In other words, proportionally to what did they pay last year. So I would say previous year they paid 1422 out of 7110, so they paid out 20%. And so we'll continue to pay 21%. We'll say times. In other words, we're saying that plus 20% times 86.9, and that's the dividend that we'll be paying. All right, and, let's add another row here if we could. In fact, let's add 2. This was nice about Excel. You can always, I didn't need that. I got one extra here. You can play with it so much. Okay, let's add this one. We'll call this 2. Or even better yet, let's call it addition. So over here, again, net income only has 2 homes. So what isn't paid out as a dividend must be retained for investment. So that one minus this one. So we will add 69.5 to our retained earnings. Okay. Now let's make a forecast of the 220 balance sheet. So this is 2019. This will be 2020. Okay, we'll make a forecast. And the method we're using is technically called the percent of sales method. That means that the balance sheet items remain a constant percent of sales. So for example, let's do cash. You don't need to write this down, just follow it. We're going to go back and do this anyway, but let me just show you. Cash. So cash for 2019 was 20. Okay, so sales and this is for 2000. Okay, so what percent of sales was cash? And so let's just see, so do a percent of sales. And you can see very well it's 1%, isn't it? So plus 20 divided by 2000. Now we're assuming that will remain constant. So forecast. $2020. We're going to say that cash would equal 1%. So that percent of sales remains constant times 400 equals 24. Okay, now that's technically the percent of sales method. So we hold current assets and net fixed assets to a fixed percent of sales, and we'll do the same thing with accruals and payables. Okay, but rather than going through all this, it also works if you just simply increase these items proportionally to the increase in sales. So in other words, just as I multiplied above everything by 20%, 1.2, I increased everything by 1.2, I can do that here, and I get exactly the same number. So I'll do that for all of these, and then we'll do an auto sum. Whoa, boy, oh boy, don't want to do that, do we? All right, we get 600, and then we'll do the same thing for net fixed. We'll increase those by 20%, and then obviously we'll get a total here, won't we? $1,200. All right, let's continue on the right side of the balance sheet. We have a 20% increase in sales. With a 20% increase in sales, do we necessarily issue 20% more common stock? You do not. So there's two parts to the right side, actually. Some of it is part of operations, part of it is strictly financing. Okay, so from here down, this is all financing. These two are part of operations. So these two will track sales. So sales up 20%, each of these will do exactly the same. So I'm going to increase these by 20%. These are operating current assets. Now what's notes payable? What is that? That's a financing alternative, isn't it? You're borrowing money. That's financing, that's not operating. The fact that you increase sales by 20% does not mean you'll borrow 20% more notes. Okay, so let's do the same to accruals. That's good. So let's leave these just as they are. Current long-term debt, and then let's add all this together. Okay, now let's do the long-term debt. Leave that alone for now. I won't say it'll stay this way. Okay. Common stock. Are we issuing new common stock because sales increased by 20%? No, not necessarily. In fact, not at all. I better. Okay, retained earnings. Now we know something happened there, right? Because from the income statement above, we're going to start with 200 plus, and what did we make a special roll for? We identified what part of our income will be retained for investment, and we know that it'll be 69.5. Okay, so your total equity is the sum of these two, and your total capital, the capital side, would equal your current liabilities plus your long-term debt plus your equity. So what do I have so far? I have 1,200 in assets. I'm attempting at this point to finance this with 1085.52. That will not work. So how short are we? So here's our external funding requirement. Have to go outside the company. Okay. And of course, that one way, we're going to find this several ways, but we're going to get the same number. We're going to say that we're trying to finance 1,200 in assets with 108552 in capital, therefore we're short 1448. Okay, so let's go back here and let's identify our new assets. Well, for this it's pretty easy, isn't it? You're increasing assets from 1,000 to 1,200, so you have to fund 200 in additional assets, don't you? Okay. All right, and then let's identify our internal sources. Okay, and what do we have? Well, we'll be increasing payables by 8. We will be increasing accruals by the same amount. Okay. Now, this part will take an active intervention. That won't just happen because sales increase. So we're going to leave these two as they are. Oh, sorry, leave it alone, period. I'm sorry, I'm just estimating internal sources. So there, that's internal, that's internal. Any changes here would be due to an external change. And then over here, that's our other internal source, our addition to retained earnings. So we have control over these internal sources. This is what we are doing, right? And so if I add my internal sources together, I have let's add these together. So sum. By the way, what does Excel do with all these blank cells? When I leave cells blank like this, what happens here? Well, Excel ignores blank cells. And sometimes that's not as handy as you think, because I might have a range of values that are equal to 0, and I know they're 0. So I just leave them alone. Well, no, you can't do that. For Excel to treat it as a 0, it has to actually say 0 in it. A blank is not equivalent to 0. So here's my internal sources. So of this 200 in new assets, I can fund 85.52 internally. So we'll do the difference and see what we have to fund externally. So we have 200 in new assets, and we can fund 85.52 internally, and the remainder we would have to fund externally. All right, now another way of doing this is to work with something called the, actually, you know what, let's do another thing. All right, I work this part like this because you are familiar with these statements. I mean, they're rather simplified, but they're in a familiar format. If you were to go into a corporate valuation class, they wouldn't do it this way. So we are going to restate these financial statements as you would see them in a valuation class, or actually as you will see them in chapter 29, from which your next assignment comes. Okay, so let's come in the middle here somewhere. And the income statement's okay. Nothing, you can't change that. Let's do 2019, and we're going to restate this. Let's see, how are we going to do this? How about 4 here? That looks good. Underline these, and maybe come here. The right border, okay. So we're going to start out with something called net operating working capital. So maybe over on the side here, let's define what that, well, we can do it down here. Okay. And the definition of this will be okay, so operating current assets minus operating current liabilities. And for us, this will not be terribly difficult. We are going to say that all current assets are operating current assets. Okay, so we're going to do cash plus accounts receivable, is that okay? Can I say AR plus inventory minus, and then your current operating liability or operating current liabilities will be simply accounts payable plus accruals. Okay. So let's do our net operating working capital for 219. Okay, equals. Okay, let's come up here. Yeah, just be the 500 minus. So minus the 40 plus the 40. So I'm showing 580. Yeah, so 500 minus 20. Okay, then the net fixed assets. And let's take those as they are.
Wait, I have a question.
Oh, what'd you do? What'd I do wrong?
Are you supposed to subtract?
You're absolutely
But
right.
I typed that wrong.
You got it perfect. I hit the, sorry about that. Everybody catch that? I hit the wrong key. My fault. I said to subtract these, but for some reason I hit the add key. It's always good to have someone in class that helps me out like this. There we go. So here, let's do this again. So it is the 500 minus the sum of 40 and 40. Why do I? That didn't feel right. Now I know why. Okay, see if I can do net fixed assets right. I can find a way to mess this one up. Let's come right. Right there. 500. All right, and then let's come over here. So, do you see what we're doing here in effect? We are in effect subtracting 80 from both sides of the balance sheet, aren't we? Okay, so we're going to take it out of here. So now we have to do the other side. So the other side has but two items in it. One is debt, and the other is equity. I've never done a company that had preferred stock, but I'm going to believe that you'd have to include that as a separate item. So debt and equity. Okay, so debt. And just a little meaning here, what I do is so everything on the right side that bears interest. See if I can do this right. So I'm going to say equals. Okay, that's interest bearing. That's interest bearing. That's interest bearing. I get 220. And equity. Of course, equity. Oh, so sorry. Let me do this again. Well, it didn't matter, I guess. We should be doing 2019. Did I do that here? I did, okay. Yes, I did. Okay. And then your equity. Just get your total equity. And that was 700. Okay, then if life is good, you should have equaling sums on both sides. And we do. All right. Okay, let's continue. And let's do the same thing for 2020. All right, and let's start out with all the same, no issues here. So net operating working capital equals so 2020 would be the 600 in operating current assets minus, I hit minus this time? Yes, I did. Minus the sum of payables and accruals. Okay, net fixed assets. All right, net fixed assets. That would be right here, 600. Okay, so on the left side, we will have a total of 1104. We'll have our debt and equity. So our debt equal pretty much the same thing. 200 plus 10 plus 10. Our equity, total equity. And we'll add these together. And we have a mismatch. But what's the amount of the mismatch? How about that? Same number we had before, isn't it? Okay, now one thing I didn't do, and I probably should have, and that is we can't leave this balance sheet hanging like this. You see that? It's not balancing, is it? So what I'd like you to do, if you're following me, I'm just gonna nudge these over. I'm gonna nudge these over 1, and then I'm gonna restate the balance sheet, and we're gonna make this work. Okay, now how you make it work, you have to follow a story. And I'm going to just choose a very simple story. We are simply going to borrow enough to make this balance. Okay, so let's do the same thing here. Let's move these over. And the left side doesn't change a bit. So we can do another 2020 here. And this just stays like it is, as it is. Okay, and the current assets, yep, same thing here. Net fixed. And same thing here. So now we'll do this part. So the right side, the 48 still works. The 48 here works. And let's, again, it's going to be all long-term debt. So let's keep these for now as they are. Yeah, to be perfectly accurate, I'd have to restate all this. So I would take some portion of however much I borrow and put it in the current maturities. We could do all that, but not necessary. So this works the same. Okay, now the 200. I will take the 200 and I'll add to that the shortcoming. So we will borrow 114.48. Okay. Then everything else is the same. And hopefully I can just copy this across. And now we have a balancing balance sheet. So the solution I chose for this example was simply to borrow the external, choose as my external funding a long-term debt. Now I could possibly split this between some long-term and some short-term. I could also issue new equity, couldn't I? But I'm just keeping it as simple as possible. All right. All right. So now we have the same difference here. And now we'll do our statement of sources and uses. Okay, let's start out with our uses. Sources. What am I doing? Years ago, the statement of sources and uses was part of the financial statements where we now find the statement of cash flows. So it was done on an accrual basis before, now it's done on a cash basis. Okay, so your sources would be net income, depreciation, and since we don't have that laid out here, it'll be zero, of course. Then we'll have issuance of debt, issuance of equity, that'll give us our total sources. Okay, then we'll do our uses. Oops, what did I do? Oh, okay. Our uses will be increase in net operating working capital, assets, and our dividend. All right, just a quick note, and we will see the difference shortly, but if we actually had a value for depreciation up here, then we could not, depreciation up here, we couldn't do this on a net basis. We'd have to do it on an investment basis, and we'll do that later on. But for right now, this will work. Okay, so let's see if we can make this work. So let's sources. Okay, and let's go net income equals where we go 86.9. Depreciation, well, it's not specified here. And then issuance of debt, we're going to say as of now we don't know it. So I'm going to say equals 0. Issuance of equity, we're going to say equals 0. So as we begin this process, our total sources are 86.9. Then our uses, increase in working capital, operating working capital. So we come up to our restated financial statements, and we've increased operating working capital from 420 up to 504, so we'll take that difference. And then we'll capture our increase in net fixed assets. So 600 subtracting 500. And then we'll capture our dividend as the last of our uses. That would be right here. All right, so we will add our total uses. I get 20138, and so the difference, so I subtract my uses, subtract my sources, and just give us another decimal just to make sure it always looks the same. And there's my 1148 number. Okay, so we can use this particular format of a statement to identify our required external funding. So this difference is your that's your external funding. All right, now let's do the next pass. So the next pass, our net income will not change. And our depreciation stays the same. However, issuance of debt equals. And actually, you know what? Before we do that, let's fix this thing, can we? So let's restate our debt and equity. So so with new debt, we're going to say it equals 220 plus the 11448, and then equity stays the same. And I can add these together, and I get the same 1104, which I have on the other side. All right, so now we can do this. Okay, now I want my depreciation, net income, depreciation, issuance of debt. Issuance of debt would equal the new debt level minus what it was last year. I get that. Oh, that's not, yeah, that's right. Issuance of equity is 0. My total is now 201.4. And of course, that is actually 201.38, isn't it? And these are exactly the same. And so now I have a solution going. So far, so good. All right, let's just go back to the Word doc. Let me check in here. Okay, any questions? All right. Anything at all I can redo, or are we okay with it? Can you show your quiz C32? I certainly can. C32. Oh, I see, yeah. That would be the difference between the new value of the total assets subtracting the new value of the capital. That was my first appearance of the 114.48 number. All right, very good. Anything else? It's not very difficult to miss a cell. You can see I tried to miss one earlier, except it was kindly pointed out that I'd made an error. So it's not hard to do. All right then, let's continue then. All right. So let us first go back to the Word document and just see that you can see that everything we've done is here. Okay, so with this, the imputed 21% tax rate, we did that. And then we found the addition retained earnings, we did that. We did all this, we have the new income statement. Okay, that's all, we've done all this. So here's our pro forma balance sheets, we've done all that. Keeping in mind, you only increase payables and accruals by the percentage change in sales, right? I didn't do that anywhere else. Except now down here, retained earnings, you take the beginning value, add whatever your additional retained earnings from the income statement was. All right, and then there's our, away we go, new assets, we did all this. And we have our estimates. All right, and then we balanced it out with new debt. Then we reconfigured the balance sheet. All right, and I kind of defined everything in here. And here we go. And these are the new not balancing numbers. And so once we increased the debt, it balanced. And we did all this. So I think we're okay here. I hope you can tell that when you're finished with this process, that your uses and your sources have to equal each other, don't they? Now, you know what? This is kind of a misnomer right here. I'm going to say this is actually, is this a picture? I suppose it is, of course. Normally, you would state your external funding requirement as it's a positive number, as we got up here. In other words, it's a positive number if your asset side exceeds your capital side. Then I have to raise additional funds. I show it as a positive number. All right, what would happen if I gave you a rather stranger one and we found out that we had more capital than we had assets? Now what? Well, in that case, if you have more on the right side than you have on the left, you've got some more spending to do. You have to increase your assets to make it come out. Or you have to pay out a larger dividend. You have to make it balanced nonetheless, don't you? Okay. And I think pretty much the rest of the way we go, we'll always be finding that the asset side exceeds the capital side. So I apologize. I probably should have shown this as a positive number, and I unfortunately did it as a picture, so I can't fix it. All right. Now we'll move into, this is what chapter 29 will be like. And this is the chapter from which your next assignment comes. Okay, so let's, if we could, they have an example similar to this. Well, let's do mine here. So let's drop this into a sheet. You know what? Probably better off to get a new sheet. Rather than just keep going down and down and down. So let's paste this one in. And expand your A and B columns. Okay, and then I'll expand the whole thing. All right, in this example, 219 is the last given year. Okay, so everything in 219 is known. I don't happen to have anything in these cells because I don't need them. Okay, so don't fill out anything in here. We are to focus strictly on 220 going forward. 2020 going forward. All right? So this is our balance sheet, and it balances for 219. All right, so let's start out. And this particular story is entirely in the A column. So just do what each of these tell you to do. And why don't you take a few minutes and tell me what net income will be for 2020. Just follow the script that's in column A. Timer, we're done, hopefully we'll have some time.
Oh, I'm going slow today.
That's okay. It's perfectly fine. Okay. 10%, yeah. Okay, okay. So that's the college business. Should be 310 minus the 40, right? Oh, I know, so, okay, that's good. Okay, then the income, we get your tax, 21%. 22. Okay, there you go. Okay, my turn. So we'll go over here. And then the cost of sales, 85. Depreciation, 10%. Times beginning net fixed. EBIT. Interest. 10% of your beginning debt. Taxable. Taxes. Finally, income. All right, there we go. Looks good. All right, let's do the balance sheet. Let's hold off on these until we have a better feel for what we need to do. So working capital, let's follow the script. It says 20% of sales. Times sales. I could be a little bit fancy here. Okay, and then fixed assets are 25%. So I'll go like this, I'll double click here. Oops, and I'll change that to 25. 600. That'll give me a 1080 here, won't it? All right, we have an issue. And can you tell me what it is? Let's go to here. So we are capping our debt ratio. And how do you define the debt ratio? Debt to value, at most 40%. Okay, so we can have at most 40% of our assets funded with debt. And how do we start this whole thing out? %. So we're already not abiding by the rules when we start. Okay, so why don't you take a few minutes here and, okay, keep in mind that you can adjust your equity reinvestment to make this work. So let's maintain a constant debt ratio of 40%. So let's maintain 40%. Let's use all that we can in the debt. And see if you can tell me what we'll do here. So give it a try. Got enough time? You got it? We got it? No. Okay, we know that number. Yep. Okay, now you know what? That is actually mathematically right. But I think you'd be better off move that up to that 1080. You see, you got the 1080 here. Mm-hmm. Move that up and get that one. Okay, so in other words, your equation here is right. It's saying 40% of that number. Mm-hmm. Take 40% of that number instead. Oh. Because you see why? Because you see your debt and your equity add up to that number. So you get what's called circular reference. Oh, okay. So times 0.4, you were right. Okay, so what's the difference then? So now you just subtract that one. There you go. Wait, the top one? Well, no, anytime you're right. Right there, minus. That one's perfect. You got it. Okay, but now, you have to fix the income statement. Okay, I'm going to do this now. So right away, any balance sheet that balances must have the same totals, which looks like I made it do that. We are going to maintain a debt to asset ratio of 40%. So I'm going to say that this number is 0.4 times 1080. All right, now let's go to the equity. And it's pretty easy to see what equity has to be, isn't it? I'm going to be 1080 subtracting 432. Okay, so I have to increase my equity from 500 up to 648. correct? So where do we get those funds? Let's come up here. Right? So how much do we need to reinvest? I need 648 minus 500, correct? Okay, then what can I pay out as a dividend? So 213.3 minus the 148, that's what we'll pay out as a dividend. Does that make sense? And now you'll see that, you know, our nominal dividend was 60% of earnings, except that we don't have sufficient earnings to pay that much. So we are paying out right now how much? 65 compared to 213. So we're paying out about 31%, 30.6%. Okay, so we're nowhere near our target here, but that's because we're trying not to fund through external sources. All right, let's more than this 32 that we have for the long-term debt. Let's set up our statement of sources and uses. Excuse me. Oh. Oh my gosh. Breathing through a mask all day doesn't help me much. Okay, I'll get there in a minute. All right, let's see what we got here. How am I supposed to line up if I got a question? I'm not showing it. Let's put a question up. Oops, I want that. Maybe this typed it to someone else. Is everybody okay on this? How I came up with the dividend? How I arrived at the addition to retained earnings? All right, well, hearing none. Must ask someone else, huh? All right, so statement of sources and uses. We'll start out with net income. Depreciation. Issuance of debt. Issuance of equity. Sources. Uses. All right, see that? That's different from what we did before. Now I have the word investment here. Now I will show you how to do that. Okay, then we're going to have our dividend. All right, let's start out. Sources, net income. Let's go right over here so we match the year. I guess it'd be here, wouldn't it? Where are we at? Yeah, it'd be right here. Equals net income. Let's go up and get it. 213, looks good. Depreciation. Would be the 50, wouldn't it? Okay. Issuance of debt. So we went from 400 up to 432, a difference of Looks to be 32. I'm sure there's a decimal tucked away in there somewhere. Issuance of equity, we did not issue equity. So our total sources will be 295.3. Okay, uses. Increase in net operating working capital. That went from 400 up to 480. Investment. Okay, let's come down here. What is investment? Remember on the previous example, I didn't have depreciation, did I? Okay, so what we'll do here is, because we do have depreciation and we've included it as a source, we basically have to add that same amount to the top and bottom here. So do you remember when we just did the change in net fixed assets? What did we do? We did ending net fixed assets minus beginning. Net fixed assets. Yeah, that's all we did, right? We just subtracted okay, but now we've added 50 up here. And so to make this work, you have to add the same 50 here. So we're going to say plus depreciation. Okay, and that's the way we do it. So let's try it. Our investment would equal, so ending net fixed minus beginning net fixed plus depreciation. Okay. Then we come to dividend, which we know. Okay. And our total uses. It's not exactly the same, doesn't it? Okay. What we just did is an example of what's called the residual theory of dividends, meaning that you pay out all that you don't need. So in this particular example, we earned 213.3. We required of that 148 for investments. Therefore, we paid out what was left over, and that's 65.3. Does that make sense? That's called the residual theory. Residual means left over. All right. And then on, let's preview Thursday a little bit, then we'll get out of here. But on Thursday, we will follow a different type of, sorry, before I say that, I would like you to finish 2021 and 2022, and the answers to those are on the very last page of the Word document. So you'll see the answers there. Okay, now the other theory that we will follow on Thursday, we will finance according to what one of your authors calls the pecking order theory. And the pecking order theory, and we'll go over this again, but it means that you would, let's think, I mean, okay, it's actually very common sense, I think. But what if you wanted to buy something? What would be your first choice, personally? Well, can you buy it just with whatever you earned this month? And so your first choice would be to use your own funds, and that's, according to the pecking order theory, the first source companies prefer to use is their internal sources. Okay, then what's your next source? Okay, you don't have enough. You're buying a car. You don't have enough. What do you need to do next? You would borrow it, wouldn't you? Okay, so a company, the next preferable source is to borrow externally. And then one thing we don't do personally, of course, and that would be, and a company would have, would be equity. So they could also issue new common stock. That would be their last choice. Okay, so the pecking order, start with internal fundings, then borrow, then issue new equity. But again, steps 2 and 3 occur only if step 1 is insufficient. And step 3 occurs only if step 2 is insufficient. That's why it's a pecking order. Anyway, we'll get into that, and we'll redo this based on pecking order theory on Thursday. So I will see you then. Check for any last minute questions.